This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. This is a joy. Every research report is the character of the individual. Stephen Schork knows every valve in the Northeast on oil. He's gone out there, he's turned them. When you say, what's Harbor doing? He could give you 6 flavors of the price of oil in New York Harbor. It is an acuity on oil and gas like we've never seen. He's a Schork report. Can't say enough about his work. Stephen, good morning. As simple as I can, are we energy independent now? Within the holistic Schork report, is this nation energy independent?
Absolutely not, Tom. We were up until a few years ago. That is to say, we were producing a tremendous amount of oil. Now we're back to those levels, and actually we're at record levels. But the investments that we are seeing have certainly held us back. And there is a misnomer out there when people hear energy independent. They kind of think, well, hey, we're not reliant on imports or so forth. We are. We do export a considerable amount of products, gasoline, diesel, jet fuel, so forth. And we're also at times significant exporters of crude oil. That was never the case up until a few years ago.
Yeah. I mean, this is interesting, Damian. I just want to say on YouTube, all the secrets are given away. Steve Schork is coming to us from right off the 9th tee at the Ocean Forest Golf Club, Sea Island, Georgia, this morning. Oh, we're getting him in the middle of his games. That's a good thing.
Sea Island, you should be going skeet shooting down in Sea Island, Stephen.
No. I'm actually doing market research. I am working this quarter from Curacao. And we're on the south part of the island with direct sight lines to the Venezuelan shipping lane. It's been very interesting. So I'm watching the tankers go back and forth. So this is all work related.
There's an umbrella in his tang.
Sure.
Damian.
So Stephen, I have to ask you, we have Brent here at 79.06 grappling with the psychological $80 a barrel level. Level it hasn't seen since November, quite honestly. My question for you is, in the futures complex, you mentioned open interest on the rise, volumes rise. What are you getting from sentiment? What are options markets telling you?
So right now we're starting to see some activity building up. We've been in a significant downturn in oil prices since October, since the start of it. And I'm going to call it Iran's war with the West. Mm-hmm. And we've only seen prices go lower at this time. And I'm of the opinion that really traders are whistling past the graveyard here. But what we're seeing now in the complex, the futures complex, is first and foremost, open interest is rising. Mm. Now, algebraic notation, when prices are falling, that's a negative. Multiply that by rising a positive. You have a lot of money that's been coming into the market that's been short. Yep. And in fact, when we look at the large speculators, they are short the equivalent of about 670 million barrels of oil. That's about 95% of the Strategic Petroleum Reserve equivalent. So you have a tremendous amount of bearish bets, and volume, intensity has been building. Now, just based on, I just looked at the numbers coming in. Up until this point, volatility, price variance has been falling. That's starting to rise now in the spreads. You're starting to see a premium being placed into the spot market. So this is clearly a sign that the market's getting ready to potentially explode. You have a lot of money in the market. A lot of that money is short. Trading volume has been intense. Now volatility is picking up. All you need is one more headline, i.e. something out of the Middle East.
You got it.
You could really see oil take off from this point.
You're taking the words right out of my mouth, Stephen. OPEC Plus, can they keep the supply cuts up? Are you expecting them to be able to hold fast in the face of Brent crude below $80?
No, I'm not. And I think with OPEC, people kind of think it's not a corporation. It's not that, okay, the board or the CEO makes a decision and the company carries it out. No, it is a organization that is a multifaceted, all different countries, all acting on their own self-interest. And of course, Saudi Arabia, they're trying to rein in production, but mainly your African producers need the cash at this point. So it's really difficult now for OPEC,
Right.
i.e. Saudi Arabia, to keep control of production.
One final question, Stephen Schork, and I look at this with a gallon of gas. John Tucker's not here to give us a gallon of gas update with a Hummer, but are we anywhere near a gallon of gas where we shift to electric vehicles? What a 6 months it's been in the electric vehicle debate. You've provided real leadership here. Do electric vehicles need a higher gallon of gas price to succeed?
Yeah, absolutely. And Tom, as you know, in economics, there are two variables that drive prices and demand, and that's essentially price shocks, which since the Arab oil embargo in the early 70s, we've had plenty of shocks to the market, but we've never had that second variable until recently, i.e. the substitute. But the problem now with substitutes or with EVs is technology. And I'm only to speak, from my own perspective anecdotally. I have an electric hybrid plug-in, and I love the darn thing. But the problem is I'm not buying them. I'm just leasing them because every 3 years the technology improves.
Right.
So now, and I'm not the only one. So there's this overhang of used EVs that's no one's buying. So no one's buying those. It's going to be very difficult. So prices right now under that $4 gallon are not high enough to really push consumers back to complete EV.
Stephen Schork, thank you so much. The Schork Report coming from his studios in Playa Lagoon, Curacao. We literally have research notes that say Daco like taco. I mean, good morning, Mr. Daco like taco. Good morning. As I said, nice to see you here. Mark, and people like Mark Crumpton, he knows everybody's name cold. And I'm like useless. So they got a big flashing billboard here. Gregory Daco like taco, wonderful to have you here. With Ernst & Young, EY. He's their chief economist, and it's more than just like market economics. What's GDP going to do? It's like the fabric, the makeup of our economics as well. And Greg, I've got to go seriously here to this analysis of the new productivity. Mm-hmm. Do you at EY, with all of your abilities in corporate America, have any understanding of the new productivity, or do we have to wait 5 years to find out what it is?
Do we have to wait until it happens to actually talk about it? No, I think we can talk about it today. I think what's very interesting in our insights that we gather at EY is that we talk to a lot of CEOs, we talk to a lot of business leaders as to how they're navigating this highly uncertain environment where inflation and cost fatigue remain very much a constraint on economic activity and where supply remains very much fragile. And there's a lot of effort happening from CEOs across the different sectors of the US economy that are trying to alleviate some of these pressures. They're looking at ways to improve processes and stimulate efficiency gains via these process improvements, but they're also looking at technology as an avenue to stimulate stronger growth and less inflation, and that's where Gen AI
Damian,
comes
to
in.
me, this is the heart of the matter. Is we go tech and we say AI, and it's all EIO, it's all technology, and the answer is what matters is tech on Monsanto,
Right, exactly.
or tech on DuPont. It matters just as much.
Well, Greg, first of all, let me apologize to your father for Tom butchering the Daco last name. But in your most recent macro pulse, you're talking about the disinflationary winds that are still blowing, and I wonder if you could just help us understand why the market is so hyper-focused on next Friday's PCE print. What's so important about it? What should we be looking for?
Well, the simple answer is that the Fed will be reacting mechanically to inflation developments over the course of this year. Right. And that's why there's a lot of focus on the next data print. And I think the next.
And what are we expecting there? Is it?
We'll show lower inflation. We're going to see this ongoing disinflationary momentum. We'll likely have core inflation ending 2023 below 3%, which is something that very few forecasters
only 3, not 2.5. I thought 2.5 is the number we're looking for there.
Well, core inflation under 3%, which is quite the feat. I think the disinflationary currents will continue. We have an environment where we're seeing gradually moderating final demand growth. We're seeing supply that is relatively well served. We're seeing an environment where businesses are looking for wage growth compression as an avenue to limit costs. We're also seeing an environment where there is less pricing power and much more sensitivity to increases in prices. And then rent disinflation is still very much in the pipeline. So that's the right combo to get more disinflation.
The look ahead into next week, into February, into 2024, rent disinflation to me is my number one watch.
Of course it is. Of course. But, we could talk about shelter and we could talk about inflation until we're blue in the face, Greg. But, one of the interesting pieces you just put out is on Gen AI. Mm-hmm. And, Tom is not convinced on AI. Okay. I'm just going to preface that. And yet I'm reading this wonderful piece about the productivity boost and, what the impact of it is and job reshuffling. Talk to us a little bit about what you believe the economic impact of Gen AI is going to be.
I think the economic impact of Gen AI is going to be felt across most sectors. It may not necessarily be a game changer in the sense that it multiplies the pace of growth by a factor of 2 or 3, but it is going to have a significant impact. The way we look at it is that there's going to be a need and a desire to invest a lot in Gen AI. There is a need to invest in the infrastructure, the software, the company adoption. That is going to lead to a boost of GDP. After that, we're also going to see significant productivity gains. We estimate that over the next decade for the U.S. economy, we could have a boost of 3.5% of GDP. Wow.
Okay, guys like you in fancies, you see how Greg is dressing now? He's with EY. He used to dress like a market economist. Now he just like he's consulting to somebody at $10,000 an hour down in Dallas or flying in.
He's wearing contacts now. He ditched the glasses.
That's the heart of the matter. Now, to get wonky here, I'm looking at productivity, and we of course, we lost this year the giant of productivity, Robert Solow of MIT. Yes. I got capital dynamics, I got labor dynamics, and I got this wacko thing called total factor productivity. Mm-hmm. Which of those three is the shock forward to our new American productivity?
Well, it's a timing issue, right? Initially, you have to invest. So initially, the boost to economic activity actually comes from the additional investment necessary.
Capital deepening and that.
Capital deepening and capital investment generally in technology. After that, you get the benefits in terms of productivity growth. And it's not going to be, some magical number that comes out of nowhere. It's actually going to be more efficiency in the way we do our jobs. Yeah. And it's going to be across sectors. And I think we have to step away from this notion that it's only going to be low-skilled jobs. Actually, high-skilled jobs can be augmented quite tremendously by Gen AI.
Let me quantify this for our audience here. Greg estimates, and the team at EY estimate, that the lift to global GDP from stronger productivity could total, are you ready for this, between 1.2 and 2.4 trillion over the next decade. But that's not just the U.S. now, is it? Where do you think the impact of that productivity boost is going to be felt most? Is it going to be the U.S.? Is it Europe? Is it Asia?
I think the U.S. is going to benefit most from that because the U.S. is essentially leading the way when it comes to these new technologies. But Europe is investing a lot. And then after that, you have China and the rest of Asia that's also following very closely. So that's going to be a positive boost in terms of global economic
How activity. Do you at EY treat China? Hang Seng is cratering, et cetera, et cetera. What is the EY summary of how China will recover?
Well, I think we have to understand that China is no longer going to be the global engine of growth that it once was. We're going to be in an environment where there are cyclical headwinds in terms of economic activity. We're seeing less spending in terms of retail sales, industrial activity, the real estate sector, but we're also, and very importantly, seeing structural headwinds. The population is not only aging, it's also shrinking. Yeah. That is a big drag on the economy's potential growth. Yeah. And I wouldn't be surprised that in the next 5 to 10 years, China grows at an advanced economy pace rather than as an emerging economy pace.
Greg Daco with us with EY, just really, really valuable.
So important.
Have him in here. A lot of different, you get a whole different perspective from the major accountancies and consultants than you do from people going, what's GDP going to be?
They've got no skin in the game. That's right. It's an unfiltered, unbiased opinion.
Joining us now, Brian Levitt with Invesco. Brian, I got some chit-chat, but because of time, let's get right to it now. Is cash an asset for Invesco?
Well, investors are clearly viewing it as an asset, and I think it does hold a place at certain times. The challenge is right now with yields above 5%, investors are loving it. The risk that they have is reinvestment. And so if we're right and the Federal Reserve is going to be normalizing the yield curve, well, then those yields will come down. We've been telling people, lock it in. If you like yields for 30 days, you'll probably love them for 5 or 10 years.
Brian, I want you to put on your foreign exchange hat for me for a second. I'm going to talk about one of your close colleagues, Alessio DeLongis, who's a senior PM, head of global tactical asset allocation at Invesco, and his work on factor investment in foreign exchange. Talk to us about the beta regime that we're coming out of, one where FX performance has really been driven by rate differentials. Are we moving into a new regime where value is going to take control of that? Talk to us.
Well, I think over the next couple of years, we will. I mean, typically what happens as the Fed normalizes the yield curve, you start to unlock some of the value that exists in the world, whether that's in U.S. value stocks, whether that's in right now international markets. The challenge we have in the near term is that we got a lot of returns in November and December. I wish we would have paced them out over a longer period of time. So you have growth below trend right now, the market recalibrating where the Fed's going to be in March and by the end of the year. So you may see a little bit of a quality, growthy trade again in here. But if you're an intermediate term investor expecting the Fed to normalize the yield curve, then yeah, value-oriented investments should perform well over the next couple of years.
And talk to us a little bit about the end of QT. I mean, there's been some talk that it's going to end early. Talk to us about central bank runoff. Does this have the potential to crowd out other fixed income asset classes?
I don't think it does. I mean, the fixed income market has been behaving, I would say, appropriately. If you look at where the 10-year Treasury has been, it's now hovering around what the nominal growth potential of this country likely is. So I don't think that this is being significantly manipulated one way or the other. And as the Fed has wound down its balance sheet, the markets have operated just fine. I think it makes sense. Right now, policy is just too tight. 5.25 on the funds rate, slowly winding down the balance sheet when growth is slowing, policy is too tight. So we should expect an easier environment going forward.
Brian Levitt, thank you so much. Too short a visit. We'll do it again soon. Brian Levitt with Invesco there with a more holistic view on your asset allocation. Now joining us, a gentleman of inherent optimism. He has points where he can wax philosophical and get gloomy, but Neil Dutta with us, with RunMac, and I made very clear he was out front with optimism amid the gloom, I'm going to call it 14 months ago or so. I just looked at Atlanta GDP, and after a 4.x% Q3, we're modeling out somewhere in the vicinity of a normal American economy, 2.3%. That seems better than good versus the gloom of recession. Neil Dutta, thank you so much for joining us. Is 2.3% a run rate for the American economy?
Yeah, I think so. I mean, I think we're probably in a range of around 2 to 2.5%. I mean, it's important to note, as you did, that we're coming off of a very strong quarter in the third quarter. So it was, I think, inevitable that the economy would buckle a little bit under its own weight. I mean, you can't sustain that kind of momentum. But I think what's important, Tom, is that, that estimate you mentioned, Atlanta Fed around, let's say 2%. I mean, that's despite a pretty significant decline in inventory investment. In other words, inventories are cutting GDP growth. And so final sales look pretty healthy. Right. And, I think that's important because, ultimately, firms are going to replenish inventories. And when that happens, it supports cyclical areas of the economy. Yeah,
Robert Burgess of Bloomberg News has my chart of the week, folks. It's a log regression of retail sales since time began. I think it goes back to the War of 1812. And the answer is, with the noise around the great financial crisis, the noise around COVID, with the stimulus, we've had a massive retail boom. Money question, Neil Dutta, does retail consumption sales, do they come back to trend line, or do we need to assume at some point we see diminished consumption off long-term trend?
Well, I don't think it's coming back to that trend line. I mean, absent some kind of a recession, people tend to keep on spending money so long as the economy and employment are growing, and that's what's happening. You mentioned a lot about the stimulus, but I really think that that's, yesterday's story. I mean, ultimately, what's driving consumer spending at this point is a revival in real incomes, right? So Inflation has slowed, the labor markets are steady, and as a result, real incomes have been accelerating. So that's ultimately what's driving consumer spending. And I think that that's poised to continue. It's one of the reasons why consumers are a bit more confident. I mean, the fact that prices have come down, and that'll likely continue over the next couple of quarters, that's important. And that decline in price inflation lifts real incomes, obviously, and that in turn supports consumer spending. This story, the excess savings, fiscal stimulus, these arguments, I think, have really outlived their usefulness.
Neil, financial markets appear infatuated with next week's PCE deflator print. Talk to us about that. What are you looking for next week?
Well, I think it'll be a soft 0.2. I think the Bloomberg news consensus is 0.2. I think it's a soft 0.2. But, what I would say is that, for all this talk about the last mile of inflation is the hardest, it's a bumpy road back to 2%. It's important for people to know that core PCE inflation over the last 6 months is already running below 2%.
Right.
It's at 1.9% at an annual rate. So, keep in mind that, the Fed believes that core inflation this year is going to be 2.4% year over year in the fourth quarter. We're running below that. So I think by the time the Fed meets in March, they're going to have to revise down their core inflation estimates yet again. And I think it's going to be very difficult for them to, push back on rate cuts at that point. I mean, so they may either they're cutting in March or they're using the March meeting to set up a rate cut in May.
Neil, Tom is right. You called it. Looking back some, year and a half ago, you were fading the hard landing scenario. You were calling for the soft landing. It materialized. And here we are today, and the markets are still looking for a soft landing. Do you agree with that?
Yes, I do. I mean, I think the markets are right to anticipate a benign scenario. I mean, there's a lot of inertia behind the disinflation process. I mean, I think this time last year, Powell probably, in my view, was prematurely, frankly, declaring the start of a disinflation process. I mean, at the time, I wasn't arguing for soft landing; I was arguing for no landing.
Right.
But I think at this point, we have a soft landing unfolding right before our eyes. I mean, I have a fair degree of confidence that inflation is cooling off. Keep in mind that used car prices will probably decline quite sharply over the next several months. That's not something that we saw in either November or December, but it's likely something we're going to see at the start of the year. And we know that housing rents are moderating. Well, at the same time, the economy is growing.
Yeah, that's where I wanted to go, because to me, that's the theme for the day. Julia Coronado out with a chart on this. Joe Livornia, I thought was quite good this morning. Let's hear from Neil Dutta of Renmac. And Neil, the fact is shelter wrapped around rent, and not this goofy OER, which I have no idea how it's calculated. But what's the actual countable disinflation you see across multifamily, across single home rentals, like what Blackstone's doing, and across home ownership in America?
Well, it's interesting you mentioned OER. I mean, one reason why that number is looking a little bit firmer, Tom, is because the owned housing stock obviously is more single family than multifamily, right? And so single family residential rents have been holding up a little bit firmer than apartment rents. We saw yesterday, as an example, that multifamily completions jumped sharply. And so we do have a lot of apartment supply coming on. But I think what's important is that new tenant rents, which is what the BLS released yesterday, that index is down about 4.5% against last year. Now, it probably overstates things. That is clear in the data. It tends to exaggerate the swings in the CPI number, but it does tell you fairly clearly what the direction of travel is: lower. And so, I think housing and rental inflation will continue to melt over the next couple of quarters. And again, that will support a recalibration of monetary policy this year.
I got one final question. It's really important. Do we need to model out after pitchers and catchers? Like if we get out near opening day where the Detroit Tigers start strong, they're going to be playing 1,000 ball by, they're going to win opening day, and then it's downhill from there. Neil Dutta, when we get out to April, are we going to have some form of inflation series, 1.x%? Can it get below 2?
I mean, It's plausible, as I mentioned. I mean, we're already there on a 6-month basis. And, you still have some disinflation in front of us. So it's certainly plausible that you'll be, on a glide path below 2%.
Damian's trying to make someone
Neil. I mean, Tom, John, Lisa, they always want to know from you because, they want to know about the U.S. economy. What I want to know is I want to know your thoughts on China. I want you to talk to me about China deflation. I want to talk about dollar yuan. I want you to talk to me about the property sector and this economy that's so clearly on its back. And forget about investing in China. What's the impact on global financial markets and valuations here?
I mean, to me, China is a bit of a black box. I don't follow it very closely. What I can tell you is that for all the weakness in China, it's important to note that, the emerging markets outside of China have been holding up reasonably well during this period. So I think that's notable. So maybe, the 2000s were all about how China was sort of the incremental driver of demand globally, and maybe that's not as much the case anymore.
Hugely valuable. Neil Dutta, thank you so much. A lot to chew on there, folks, with optimism on the American economy wrapped around a better than good real wage. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.